A very good afternoon to my dear friends. Friends, at the outset, I would like to convey my sincere gratitude and thanks to the Taxmann team for giving me this wonderful opportunity of sharing my insights on one of the most practically oriented and hot topics today. That is how to make an informed choice between the old and the new personal tax regime in order to optimize our tax outflows. Friends, our honorable CBDT chairman in a recent interview has said that the Union Budget 2023 has sweetened the new personal tax regime. Well, indeed, the new personal tax regime has been sweetened by way of increase in the basic exemption limit from 2.5 lakhs to rupees 3 lakhs and increase in the threshold income limit for rebate purposes under section 87A from the existing rupees 5 lakh to rupees 7 lakhs, and also the allowability of the standard deduction in the new regime as well. However, it needs to be seen whether these sweeteners are enough to satisfy and satiate the sweet tooth of you and me. Friends, I would like to rephrase this choice between the old and the new regime as the choice between available deductions and tax rate reductions. So basically, it is a trade-off between the reduced tax liability by way of reduced tax rates in the new regime vis-a-vis the availability of deductions in the old regime. And we have to choose between the two. And obviously, it is a $1 million question. And by our today's webinar, we will be trying to answer this intricate question in the most exact manner by way of some practical case studies and in-depth break-even point analysis. So with this, I would like to share my PPT and start with my PPT. I'm sharing my screen now. I hope my screen is visible, Komal. My screen is visible?
Yes.
Okay.
It's visible.
Yeah, thank you. So let us proceed and begin our journey. Friends, first of all, the coverage of the webinar. In our today's webinar, we will be discussing all the budget amendments in the new personal tax regime, which have been announced in order to make it more appealing to the taxpayers. Then the deductions which can be claimed in the new personal tax regime as well as in the old regime. Then deductions which can be claimed only in the old personal tax regime. And this new personal tax regime has been made the new default regime. So we'll be discussing the implications of the same. But of course, the comparison between the tax slab rates in the new and old personal tax regime. And most importantly, we will be discussing the break-even point analysis at different levels of income to facilitate the choice between the old and the new personal tax regime. Then I will be giving some practical tips for home loan takers also, vis-a-vis the choice between the two regimes. And most importantly, the practical case studies on old versus new personal tax regime. Also, we will be covering the impact on taxpayers opting for the presumptive basis of income under section 44 AD or ADA, vis-a-vis the choice between the old and the new regime. And then a passing reference to the income tax calculator and reference articles. So let us begin. Friends, the backdrop first of the new personal tax regime. Friends, in alignment with the standing committee on recommendations of the Standing Committee on Finance of the Direct Tax Code, the government has introduced the alternative regime or the new regime under section 115 BAC with effect from financial year 2021 and onwards. So in this new regime, the tax slab rates have been reduced, but the benefit of the tax slab rates, reduced tax slab rates can be availed only with the condition that the available deductions under section 80C, 80D, 80TTA or other numerous deductions have to be foregone by the taxpayers. So basically, this is a trade-off as I have already discussed. And however, this very condition of compulsory requirement of foregoing of the majority of the available specified deductions, opting for the new regime by the persons, has made this new regime less popular among the masses. However, the government wanted more and more taxpayers to switch to the new regime. for simplicity's sake and for ease of return filing purposes. So in order to make this new regime more appealing and attractive to the taxpayers, in the Union Budget 2023, a host of significant amendments have been announced, and we shall be discussing those amendments. Friends, first of all, this new personal tax regime under Section 115 BAC, subsection 1A, has been made the default regime with effect from financial year 23-24 and onwards. We all know that up till financial year 22-23, the normal or the regular regime with available deductions and higher tax rates is the default regime. However, the Union Budget 2023 has completely reversed this scenario, and now the new personal tax regime will be the default regime, and the persons who wish to benefit from the available deductions only in the old regime will now be required to file their declaration or to choose the old regime in their ITR forms or in the declaration forms. Currently, we are the persons who want to opt the new regime have to exercise this option, but and we will be discussing this aspect in detail in ensuing slides. Secondly, the basic exemption limit has been increased from rupees 2.5 lakhs to rupees 3 lakhs in the new regime. This exemption limit increase has only been done only in the new regime and not in the old regime. Further, in the new regime, the tax rates, that slab rates have been revamped and relaxed a bit. Now the new revamped slab rates are up to 3 lakh rupees nil tax, then from 3 lakh to 6 lakh 5%, from 6 lakhs to 9 lakh 10%, from 9 lakhs to 12 lakh 15%, from 12 lakh to 15 lakh 20%, and 15 and above 15 lakhs 30%. Friends, up till financial year 22-23, the tax slab rates in the new regime are there are 6 in number. There is one additional slab rate that is from 12.5 12 lakh 50,000 to 15 lakhs, and an additional slab rate of 25% is also there. But with effect from financial year 23-24 and onwards, this slab rate has been done away with, and now only these 5 slab rates are there. And friends, there are total 122 budget amendments in the Finance Bill 2023 which have been proposed, and I think that out of these 122 budget amendments, one budget amendment which has attracted the limelight and garnered all the attention from all the quarters and especially the middle class is the increase in the threshold income limit for rebate under Section 87A from the existing rupees 5 lakh to rupees 7 lakhs. The up till financial year 22-23, this rebate limit under both the regimes, old as well as new, is 5 lakh rupees only. But with effect from financial year 23-24 onwards, this limit of rebate in the new regime only has been increased from rupees 5 lakh to 7 lakhs, meaning thereby that with effect from financial year 23-24 and onwards, the individuals, HUS, Association of Persons and Body of Individuals having their gross total annual income up to rupees 7 lakhs will not be required to pay any income tax if they opt for the new regime, as they will be able to claim a rebate under Section 87A of rupees 25,000. Friends, one thing to note here that this rebate under Section 87A is not available in respect of those incomes which are taxed at special rate. Say the long-term capital gain on shares on which STT has been paid, that this rebate under Section 87A is not available in respect of such long-term capital gain income. Say, so then suppose a person is only having a long-term capital gain of 7 lakh rupees, but then the applicable tax rate will be applicable and this rebate will not be available to him. Then fifthly, the standard deduction benefit of rupees 50,000 is also now available in the new personal tax regime as well to all the salaried individuals and the pensioners. This is a welcome relief. And I think that these two amendments, that is increase in the rebate limit under 87A and the allowability of standard deduction, may turn out to be a game changer in favor of the new regime. Then the deduction in respect of family pension under Section 57, Clause 2A, up to rupees 15,000 has also been allowable in the new regime. And for high net worth individuals having their annual incomes exceeding rupees 5 crores, the rate of surcharge has been reduced from existing 37% to 25%, and so their effective tax rate will reduce from the 42.74% to 39%. So for such HNIs also, this rate reduction is substantial one, and new regime may turn out to be better for such high net worth individuals. And as I've already discussed, that new personal tax regime can be opted by association of person, body of individual, and artificial juridical person as well, with effect from financial year 23-24 onwards. Currently, the new regime can be opted only by individuals and HUs. And all these amendments will be become effective from financial year 23-24, that is assessment year 24 and 25 and onwards. Okay. Moving forward, deductions allowable in the new tax regime. Friends, these, as I have already discussed, that this standard deduction of rupees 50,000 under section 16 clause IA to salaried individuals and pensioners will be available in the new regime as well, with effect from financial year 23-24 onwards. Similarly, the deduction in respect of family pension under section 57 clause 2A up to rupees 15,000 will also be available in the new regime. Then a new deduction under a new section 80CCH subsection 2 in respect of contribution to Agniveer corpus funds is also available in the new regime, with effect from financial year 23-24 onwards. Friends, these three amendments were announced in the budget. However, the remaining, there are certain other deductions also which are available in the new regime, but which are not very popular. And these are deduction in respect of employers' contribution to National Pension Scheme under section 80CCD subsection 2 to the extent of 10% of basic salary and dinners allowance in the case of private sector employees and 14% in case of government employees. So this deduction in respect of employers' contribution to NPS is available in both the regimes, old as well as the new. Then transport allowance under section 10 subsection 14 is also available in the new regime in case of specially abled person. Similarly, the conveyance allowance under section 10 subsection 14 to meet the expenditure incurred as part of the employment is also available in the new regime as well as in the old regime. Daily allowance under section 1014 is also allowable. Further, the exemption on voluntary retirement under section 10 subsection 10C or gratuity under section 10 subsection 10 and leave encashment under section 10 subsection 10AA on retirement is also available in both the regimes, that is old and the new. And further, the budget 2023 has also enhanced the exemption limit on leave encashment on retirement from the existing rupees 3 lakh rupees to 25 lakh rupees. Friends, another important deduction, the interest on home loan on self-occupied or vacant property is not allowable in the new regime, but as a corollary, interest on home loan on let out property is allowable in the new regime because there is no restriction regarding that. So this thing is to be noted. And deduction in respect of additional employee cost under section 80JJAA is also allowable in the new regime. Now coming to another important slide, that is deductions which are allowed only in the old regime and not in the new regime. And basically, it is these deductions only which obviously have to be decided upon, because it is the trade-off between these available deductions in the old regime and the reduced tax liability in the new regime, which has to be, the choice has to be made. So first such deduction is house rent allowance under section 10 subsection 13A. Secondly, leave travel concession under section 10 subsection 5. Then interest on housing loan in respect of self-occupied property or vacant property under section 24 clause B. Helper allowance under section 1014. Children education allowance. Chapter 6A deductions under 80C, like your investments in LIC, ULIPs, ELSS, PPF, etc. And as well as the employee's contribution in NPS under section 80CCD subsection 1 or 1B. Deduction in respect of Mediclaim premium under section 80D. Deduction in respect of interest paid on education loan under section 80E. Deduction in respect of donation under section 80G. Deduction in respect of royalty income of authors on books under section 80QB. Deduction in respect of interest income on saving bank under 80TTA up to 10,000 rupees, and deduction in respect of interest income on deposits with post office and banks under 80TTB up to 50,000 available to senior citizens. And lastly, the additional depreciation under section 32 subsection 1 clause 2A in case of business or on plant and machinery of 20%. So all these deductions will not be available in the new regime and will be available only in the old regime. Moving forward, new tax regime to be the default regime. Friends, I have touched upon this in the beginning that up till now, up till financial year 22-23, the old personal tax regime is the default regime, and the taxpayers opting for the new regime and having their income under the head profits and gains from business or profession are required to file their electronic declaration in the prescribed form 10IE before the due date of filing their ITRs. And those persons who are not having any business income or professional income, those can simply choose the new regime by filling the option in their respective ITRs. However, with effect from financial year 23-24 onwards, the new personal tax regime under section 115 BAC subsection 1A has been made the new default regime, meaning thereby that if the person does not opt for the old regime, then by default, the new personal tax regime will be his or her default regime. The return for ITR form will automatically take it as a new personal tax regime under section 115 BAC 1A, the reduced tax slab rates, which we have already discussed. So it becomes important that if the person wants to avail the benefit of available deductions only in the new regime, then he or she has to opt for the exercise the option of choosing the old regime. If the person is not having any business or professional income, then the choice of exercise of the old regime can be simply done by selecting the option of old regime in their respective ITR forms at the time of filing their ITRs. However, if the person is having any business income or professional income, then obviously, under section 115 BAC subsection 6, an electronic declaration form has to be filed by such person before filing of the ITR. Currently, the prescribed form is form 10IE. However, hopefully this form will remain the same, but the choice will change that in place of new regime, now the old regime will have to be opted for. Friends, such persons shall be able to exercise the option of opting back to the new regime under section 115 BAC 1A only once. Currently also, the persons who have opted for the new regime and are given an option to withdraw this exercise of the new regime only once in subsequent years. So this has one practical implication now. This new budget amendment has one practical implication. Consider a scenario where a person in the first financial year, that is 2021, has opted for the new regime. In financial year 21-22, he has the available deductions become greater. So he used his one-time opportunity of withdrawing from the exercise of new regime and has shifted back to the old regime. So as per current provisions, he will not be able to switch back to the new regime. But now, since this budget amendment has come up and the new personal tax regime has been made the default regime, therefore another opportunity of shifting to the new regime is there with such persons also. So because now the new regime is the default regime and the choice has to be exercised afresh with effect from financial year 23-24 onwards. And another implication is for salaried individuals, especially because they will be required to give their declaration forms, investment declaration forms at the beginning of the year itself to their respective employers. Otherwise, the TDS will get deducted on their salary on assuming the new regime as the default regime. And if they have some available deductions and if they want to claim the benefit of the same, then definitely they need to give their investment declarations at the beginning of the year itself. So they need to be more proactive in their decision making. And that is why this well-timed webinar has been organized by Taxmann today to make a well-informed choice. And regarding the question answers, I would request the participants that we will take up the question answers at the end of the session so that the continuity is not broken and the rhythm is not broken. Okay. Friends, this slab rate, the comparison between the slab rate, deliberately I have broken the threshold limits including all the intervening thresholds so that for better comparison purpose. So up to 2,50,000, the tax rate is nil, and from 2,50,000 to 3 lakh, since the basic exemption limit has been increased in the new regime, therefore the tax rate is nil in the new regime, but in the old regime the tax rate continues to be 5%. Friends, here one thing also needs to be understood, that for individuals having their annual total income up to rupees 7 lakhs in the new regime and 5 lakhs in the old regime, can claim their rebate under section 87A. So this tax slabs of the tax slab between 2.50 to 3 or 3 to 7 will come into picture once their income crosses the threshold limit of either 5 lakh in the old regime or 7 lakhs in the new regime. So then the slab rates will become applicable. So see, we can see the difference between from 5 lakhs to 6 lakhs. In the new regime, the tax rate is only 5%, whereas in the old regime, the tax rate is 20%. And similarly, in the tax slab rate from 10 lakhs to 12 lakhs, the new regime tax rate is 15%, whereas in the old regime, it is double, that is 30%. Obviously, as far as the tax slab rates are concerned, the new regime is the clear winner. But obviously, the choice is not so simple, and the choice has to be made depending upon the availability of available deductions to the persons. Moving forward, friends, this is the most important slide of my presentation, and I have worked quite hard on it. Friends, I am answering this question, that how to make an informed and good choice in the most exact manner and not resorting to any ambiguity or vagueness. And for answering, and in order to do so, what I have done is that at each level of income, I have computed the break-even level points in terms of the available deductions which are required to be claimed in the old regime to break even with the reduced tax liability in the new regime. Meaning thereby that at an income level of 8 lakh rupees, the deductions which are required to be claimed in the old regime should be greater than rupees 2,12,500 in order to break even with the reduced tax liability in the new regime. So at an income level of rupees 8 lakhs, if the person is having available deductions of rupees 2,12,500, then his or her tax liability will be equal or at par. Similarly, at an income level of 9 lakh, this break-even point of available deduction is 2,62,500. At an income level of 10 lakhs, this break-even point is 3 lakh rupees. At an income level of 11 lakh, this break-even point is 3,25,000 rupees. At an income level of 12 lakh, this break-even point is 3,50,000 rupees. At an income level of 13 lakh, this break-even point is 3,62,500 rupees. At an income level of 14 lakh, this break-even point in terms of available deduction is 3,75,000 rupees. At an income level of 15 lakh rupees, this break-even point is 4,08,333 rupees. And at an income level 15 lakh, above 15 lakhs and up to 5 crore rupees, the break-even point in terms of available deduction is 4,25,000. Meaning thereby that those persons having an annual income above 15 lakh rupees, if they should remain in the old regime only if their available deductions under section 80C, 80D or numerous other deductions are greater than 4,25,000 rupees. Otherwise, they can switch in the new regime to reduce their tax liability. Friends, this slide pertains to the empirical findings. Basically, this is the repetition of what I have already spoken. So I have just mentioned it again here for ready reference. So let us proceed further. One thing important is there, that suppose in the persons having income more than 15 lakh rupees, then they should consider continuing with the old regime only if their available deductions are greater than rupees 4,25,000 rupees. However, if such available deductions are equal to or less than rupees 4,25,000 in a year, or another consideration is also there, or if they don't want to block their disposable funds in making such investments of rupees 4,25,000, then they should definitely switch to the new regime to reduce their tax liability. So this is important thing, because there are certain deductions which are available without any incurring any cash outflows, like your standard deduction is there, your housing loan is interest on housing loan is there, your principal repayment is there. So such kind of deductions, obviously without incurring any additional cash outflow, you are able to claim the deduction. So that is the deciding factor. And for those deductions for which additional cash outflow is required, then obviously the individual can decide upon whether to block his or her funds or not in order to avail the tax benefit or not. Friends, now a practical tip for the home loan takers. This is my budget observation. Friends, in the budget, there is one amendment, important amendment, clarification, I should say, that the double deduction with respect of home loan principal repayment under Section 80C and interest on home loan for self-occupied property under Section 24E is now has been plugged and prohibited, meaning thereby that the deduction if the deduction has been claimed in respect of principal repayment under Section 80C and the interest on that loan under Section 24B, then subsequently, if that house property is being sold and at the time of capital gain computation, then the said interest payment and principal repayment will not be considered for determining the cost of acquisition under Section 48 or the cost of improvement. So now the double deduction will not be available, as has been clarified in the Union Budget 2023. But as a natural corollary, as I take it, is that if a person is clear that in near future or in future, the house property one intends to sell. So then at present, because in our available deduction scenarios, this interest payment of up to rupees 2 lakhs in 24B and as well as the principal repayment of housing loan under 80C constitutes a sizable chunk in the available deductions. Therefore, if the person intends to sell such house property in future, then he may think upon that currently he can opt for the new regime and forego his claim of interest as well as the principal repayment and opt for the new regime and take the benefit of reduced tax rates. And subsequently, at the time of sale of such house, he or she can claim the interest portion as the cost of acquisition or cost of improvement, along with the benefit of indexation also. So this is my important budget takeaway. So which can be helpful, especially for the home loan takers. We will understand this with the help of practical case study also in ensuing slide. Now coming to the most important segment, that is the practical illustrations. Friends, I have worked out these original practical illustrations and tried to cover the practical scenarios here. Hopefully, you will find them insightful. Friends, firstly, the first present case study pertains to the comparison between the old regime and the new regime at an income level of rupees 10 lakhs. So at an income level of rupees 10 lakhs in the old regime, the gross salary, it is a salaried employee. So gross salary is 10 lakh rupees and under the old regime, the standard deduction of 50,000 is available. As per the budget amendment with effect from financial year 23-24 onwards, the standard deduction of 50,000 will also be available in the new regime. Therefore, this is at par. Now coming to deductions under Section 80C. This person is claiming deduction under 80C of employees' contribution to PF up to 12% of basic salary. In our example, it is 50,000 rupees. Then the principal repayment of home loan, that is 50,000. And the investments in ELS, equity linked savings scheme, of 50,000. In total, 1,50,000 deduction under Section 80C he is claiming in the old regime. In the new regime, this deduction, Chapter 60 deduction is not available now. So in the new regime, these three investments will not be, three deductions will not be available. In addition, this person is also claiming interest on home loan under Section 24B of 80,000 rupees. And this deduction is not available in the new regime. And helper allowance also, 10 subsection 14, this person is claiming 20,000 rupees, but this deduction is also not available. So in total, including standard deduction, the available deductions which the person is claiming in the old regime is 3 lakh rupees. So what is happening is this, if the person is claiming 3 lakh rupees of deductions, the total tax liability in both the regimes, that is the old regime as well as the new regime, is coming out to be the same. That is 54,600 rupees, including the cess and helper education cess, helper and education cess. So this is this incidentally I have taken it from my let us go back to our table. In at an income level of rupees 10 lakhs, I have mentioned here that a break-even point of 3 lakh available deduction is required. So in our example here, since the available deduction are 3 lakh rupees to such an individual, that is why the tax liability at both the regime, that is the old and the new regime, is coming out to be the same. So which in another way means that at an income level of rupees 10 lakh rupees, an individual need to claim the deduction of rupees 3 lakh in order to break even with the reduced tax liability of under the new regime. Now, what happens if the person is not having deductions of 3 lakh rupees? Then scenario 2 is there. Suppose in our example, this ELSS investment of 50,000 is not being made by the person. Then what will happen? Then the amount of total deductions will reduce from rupees 3 lakh to rupees 2 lakh 50,000. Then in such a case, the total tax liability in the old regime will increase from rupees 54,600 to rupees 65,000. Whereas in the new regime, the total tax liability will remain the same at 54,600. So the moment the amount of available deduction becomes lesser than the break-even point of 3 lakh rupees at an income level of 10 lakh rupees, the tax liability in the old regime becomes greater than the tax liability in the new regime, and therefore the person should opt for the new regime. Now the converse scenario, what will happen in the if the available deductions increases than the 3 lakh rupees at an income level of 10 lakh rupees? Suppose in our example, the person in addition to these 3 lakh rupees also pays a medical claim premium under section 80D of up to 25,000 rupees. So what will happen? The available deduction will increase from 3 lakh to 3 lakh 25,000, and in such a scenario, the tax liability in the old regime will reduce to 49,400, whereas in the new regime it will remain at 54,600. So the moment the available deduction, the amount of available deduction increases from rupees, the break-even point of 3 lakh rupees at an income level of 10 lakh rupees, the tax liability in the old regime decreases. Therefore, the person should continue with the old regime. I hope this is clear. This practical illustration is clear. Moving forward. Case study 2. Friends, this case study 2, I have considered an income level of 15 lakh rupees. I have considered for salaried employees, but the same holds good for other than salaried employees also, because in salaried employees, the majority of the stakeholders are salaried employees, and these deductions, the interplay of deductions is there. Therefore, that is why I have considered a salaried employee illustration. But one practical case study I have taken from of a professional also. So in this case, the 15 lakh rupees annual gross salary is there. So the deductions, again, the standard deduction of 50,000 is available in both the regimes. Apart from this, the person is claiming deduction under section 80C also, employees contribution to PF of 90,000 rupees, then LIC premium 10,000, and he has also made an investment in Sukanya Samriddhi Yojana of 50,000 rupees. So in all, he is claiming 1,50,000 in the old regime under section 80C, whereas the 80C deduction is not available in the new regime. So it is not available in our. Similarly, the person has also claimed HRA allowance under section 1013A. We all know that HRA allowance is least of the following three, that is the actual HRA allowance received, or the 50% or the 40% of the basic salary, or the excess of rent paid minus 10% of basic salary. So in this case, the HRA which is coming as exempt under section 1013A is 1 lakh rupees. Leave travel concession also, LTC, under section 10 subsection 5, the person is claiming to an extent of 1,08,333 rupees. And obviously, in the new regime, these three deductions are not available under 80C or HRA or leave LTC. These deductions are not available. So in total, the person is claiming at an income level of 15 lakh rupees, the person is claiming deductions of 4,08,333 rupees, and which incidentally is the break-even point, which we have mentioned in our table, that at an income level of 15 lakh rupees, at a break-even point of deductions of 4,08,333, the tax liability in both the regimes, that is the new regime as well as in the old regime, will remain same and at par. That is 1,45,600 and 1,45,600 in both the regimes. So what will happen if the amount of available deductions at an income level of rupees 15 lakhs gets reduced from this break-even point of 4,08,333 rupees? So consider a scenario where this person does not invest in Sukanya Samriddhi Yojana of 50,000 rupees. So what will happen? Then the amount of available deductions will get reduced from 4,08,333, that is the break-even point, to 3,58,333 rupees. So if the amount of available deductions get reduced from the break-even point, then the tax liability in the old regime will increase from the erstwhile 1,45,600 to 1,61,200. And whereas the liability, tax liability in the old new regime will remain at 1,45,600. So clearly, the moment the amount of available deductions at an income level of 15 lakh rupees gets reduced from the break-even point of 4,08,333 rupees, the tax liability in the old regime will increase. Therefore, the person should opt the new regime. Conversely, what will happen if the amount of available deduction gets increased from this break-even point of 4,08,333 rupees? Suppose in our case, the mediclaim premium of 25,000 under Section 80D is also being paid by this individual. Then the available deduction will increase from 4,08,333 to 4,33,333. And then the total tax liability in the old regime will reduce to 1,37,800, whereas in the new regime, it will remain at 1,45,600. So the moment the amount of available deductions at an income level of 15 lakhs is reduced from the break-even point of 4,08,333 rupees, the tax liability in the old regime, the moment the amount gets increased from the break-even point in the old regime, the tax liability in the old regime gets reduced, and therefore the person should remain in the old regime. I hope this is clear. Moving forward. Now, at an income level of 20 lakhs also, I have taken a practical case study. The available deduction under section, the standard deduction is available in both the regimes. Then principal repayment of home loan of 1,20,000 rupees is available only in the old regime. Then NPS contribution under section 80 CCT 1B. Friends, there are three types of NPS contribution. One is under section 80 CCD subsection 1, that is pertaining to the employee's contribution. Second is employer contribution, 80 CCD subsection 2, and third one is 80 CCD subsection 1B, that is 50,000 rupees deposit. So the first two contribution, that is employees contribution under section 80 CCD 1 and the deposit under 80 CCD 1B are available only and only in the old regime and not in the new regime. So in our example, this 50,000 deposit of NPS contribution under section 80 CCD 1B is available in the old regime only and not in the new regime. Then interest on home loan self-occupied property 1,50,000 is available only in the old regime and not in the new regime. And we all know that in the initial years, the interest on home loan is greater than the principal repayment. Therefore, I have taken that also. And in addition to these, the leave travel concession under section 10 subsection 5, 50,000 is claiming, and research allowance under section 1014 is also being claimed by such an individual of 25,000 rupees. So all these deductions are not available in the new regime, but are available only in the old regime. And consequently, this person is able to claim a deduction, available deductions of 4,25,000 at an income level of 20 lakhs. So in our table, we have discussed that at an income level of 20 lakh rupees, that is greater at an income level above 15 lakh rupees. At all the income level above 15 lakh rupees and up to 5 crore rupees, the break-even point in terms of available deduction is 4,25,000 rupees. So at all income levels above 15 lakhs and up to 5 crore rupees, the break-even point in terms of available deduction is 4,25,000 rupees. And at this break-even point, the tax liability in the old regime as well as in the new regime will be at par and equal. So in our case, this break-even point of 4,25,000 rupees, the tax liability in both the regime at an income level of 20 lakh rupees is coming out to the same, that is 2,96,400 and 2,96,400 in both the regimes. But what will happen if the amount of available deduction gets reduced from this break-even point of 4,25,000 in the old regime. Suppose in our example, this NPS deposit of 50,000 investment is not being done by the individual, then what will happen? Then obviously the amount of available deduction gets reduced from the break-even point of 4,25,000 to rupees 3,95,000, and then the total tax liability in the old regime will gets increased to rupees 3,05,760 from the erstwhile 2,96,400, whereas it will remain at 2,96,400 in the new regime. So obviously the moment the amount of available deductions at an income level of 20 lakhs gets reduced from the break-even point of 4,25,000 rupees, the tax liability in the old regime increases, and therefore the person should opt for the new regime. Conversely, the moment the amount of available deduction in the old regime increases from the break-even point of 4,25,000, so say in our example, the medical premium of 25,000 has also been paid. So the available deduction are now 4,50,000, and it is in greater than the break-even point of 4,25,000. Therefore, the tax liability in the old regime will get reduced to 2,88,600, whereas it will remain at 2,96,400. So the moment the amount of available deduction at an income level of 20 lakh rupees are greater than the threshold break-even point of 4,25,000 rupees, the individuals should opt for the old regime only and not the new regime. So these are at 3 income levels. I have discussed it. I hope I am clear. Moving forward, this is a practical case study in case of a professional. Suppose a professional is there and his professional receipts from his profession are 25 lakh rupees. Annual professional receipts are 25 lakh rupees. And his professional expenses are 15 lakh rupees. So his net income in profession are 10 lakh rupees. In addition to these professional receipts, the royalty income on professional book, the professional has authored one professional book and he has earned some royalty income also. And that royalty income is equivalent to 4 lakh rupees. So his total professional income will be 10 lakh rupees net professional expense, net professional income, as well as the 4 lakh rupees royalty income, 14 lakh rupees. Now, what will happen in both the regimes? Friends, a very important deduction under section 80 QB is available in case of royalty income. So this person is claiming this 80 QB deduction in respect of royalty income, and this deduction can be claimed up to the maximum lump sum amount of 3 lakh rupees. So out of his royalty income of 4 lakh rupees, this person is claiming a deduction of 3 lakh rupees under 80 QQB in respect of his royalty income. And apart from this royalty deduction of 3 lakh rupees, he is also claiming deduction under section 80C on LIC premium of 41,670. So in total, he is claiming deduction of 3,41,670 under chapter 6A. So what will happen? At an income level of 14 lakhs for a professional, and this person is claiming deduction of 3,41,670 in the old regime. The tax liability in the old regime is coming out at 1,35,200, and in the new regime also, although the available deductions of 3,41,670 are not there, neither a deduction under section 80 B is available, nor a deduction under 80C is available, because these two deductions fall in chapter 6A of the Income Tax Act. Therefore, these deductions are not available. But in spite of not having these deductions, the tax liability is coming out at 1,35,200. So for a professional or a businessman at an income level of 14 lakh rupees, the break-even point in terms of available deduction which are needed to be claimed in the old regime is coming out at rupees 3,41,670. And at this break-even point, the tax liability in both the regimes, that is the old regime and the new regime, are coming out at equal. So what will happen if the amount of available deductions get reduced from this break-even point of 3,41,670? Consider scenario 2. Suppose this person has not paid LIC premium of 41,670. Then the only available deduction in the old regime will be 3 lakh rupees under section 80 QQB. What will happen? The tax liability in the old regime will get increased from rupees 1,35,200 to 1,48,200. So the moment the amount of available deduction at an income level of 14 lakh rupees for a professional becomes lesser than the break-even point of 3,41,670, the tax liability in the old regime increases and the person should opt for the new regime. Now, conversely, what will happen if the amount of available deductions increases from the break-even point of 3,41,670? Suppose in addition to these two deductions, the person is also claiming the deduction of Mediclaim premium of 24,330. Therefore, in total, he is claiming deduction of 3,66,000, which is greater than the break-even point of 3,41,670. So, what will happen? Now, the tax liability in the old regime will reduce to rupees 1,27,610, whereas in the new regime, it will remain at 1,35,200. So the moment the amount of available deduction at an income level of 14 lakh rupees for a professional increases from the break-even point of 3,41,670, the tax liability in the old regime will come out lesser than the new regime, and therefore the person should stick to the old regime. So this is an example of a professional. I hope I am clear up till now. Kindly confirm it in the chat box so that I can proceed further. Okay, thanks. Yeah. Now, friends, coming to another very important aspect, that is the implications of the choice of this old versus new in case of presumptive basis of income. Friends, this Union Budget 2023 has increased the threshold limit for presumptive taxation in respect of small businesses under Section 4480 from rupees 2 crores to rupees 3 crores, and in respect of professionals under Section 4480A from the existing rupees 50 lakhs to rupees 75 lakhs with effect from financial year 23 and 24 and onwards. However, these increased limits are subject to the mandatory condition that the respective cash receipts from such the small businesses or professions should not exceed 5% of their total receipts. So, in the presumptive taxation scheme under Section 44AD, the proprietor businessman declares the income at 6% or 8% of the total turnover on presumptive basis without claiming any business expenditure. And similarly, in the presumptive taxation scheme under Section 44ADA, applicable in case of profession, the professional declares the income at 50% of the total turnover on presumptive basis without claiming any business expenditure. So this is the presumptive taxation regime 44AD and 44ADA. Friends, as far as the tax slab rates are concerned, we have obviously we have discussed, and it is very clear that the new regime is the clear winner as far as the tax slab rates are concerned. But the choice is not so simple even for the presumptive taxation person, because the chapter 6A deductions like ATC or ATD or all other deductions which you have discussed just now are available in presumptive income schemes also, that is 44AD and 44ADA. So more or less the decision remains the same, that is the trade-off between the available deductions under chapter 6A or the reduced tax liability as on account of reduced tax rates in the new regime. So the trade-off has to be done, and that is why I have considered another practical case study in case of a presumptive taxation scheme. Friends, in our example, the total professional receipts of a professional opting for the presumptive taxation scheme under Section 44ATA is 28 lakh rupees. So since the person has opted for the presumptive scheme under Section 44ADA, therefore the 50% of the total turnover will be deemed to be his total income, that is 14 lakh rupees. Here, one thing is to be noted that the professional expenses are rupees 10 lakhs only. Therefore, in natural course, the net income would have been 18 lakh rupees. But since obviously the person has made a choice of presumptive taxation because it is more beneficial to him or her, therefore the income will be considered as 14 lakh only and not 18 lakh. So this is the benefit of presumptive taxation which the person is availing. Now, in addition to this presumptive taxation, Chapter 6A deductions are also being claimed by such individuals. So interest paid on home loan of 24B, 2 lakh rupees up till 2 lakh rupees, he is availing. And ATC deduction of LIC premium of 41,670 and ELSS investment of 1 lakh he is also claiming. So in total, he is claiming Chapter 6A deductions of 3,41,670. Deliberately, I have taken the same figure of deductions which we have discussed just now in our previous slide, that at an income level of 14 lakh rupees, the break-even point in terms of available deduction is 3,41,670. So at this break-even point, The total tax liability will remain the same in both the regimes, that is the old regime as well as the new regime, at 1,35,200. However, what will happen if the available deduction gets reduced from this 3,41,670? Suppose the person decides not to make ALSS investments of rupees 1 lakh, then what will happen? The amount of available deductions will get reduced from 3,41,670 to 2,41,670. Then the tax liability will get increased to 1,66,399, whereas in the new regime it will remain at 1,35,200. So the moment at an income level of 14 lakhs, we have already discussed, the amount of available deductions gets reduced from the break-even point of 3,41,670. The old regime becomes more costlier in terms of tax outflows. Therefore, the person should switch to the new regime. Similarly, what will happen? The converse scenario. What will happen if the amount of available deductions gets increased to this break-even point of 3,41,670? In our example, suppose the medical premium under 80D of 24,330 has been paid, then the amount of available deductions gets increased from 3,41,670 to 3,66,000. Then the tax liability in the old regime will get reduced to 1,27,610, vis-a-vis the tax liability of 1,35,200 in the new regime. So the moment the availability of deductions increases from the break-even point of 3,41,670 at an income level of 14 lakhs for a professional or a businessman, he should stick to the old regime, and in order to reduce his tax liability. So this was all about the practical case studies, friends. I hope I am clear up till now. Kindly confirm this in chat box. Okay, one person, please share a break-even table for professionals. Friends, the break-even table for professionals in this slide I have not covered, but later on I will cover that. But that can be worked upon by you yourself. And in our slide, how this can be done, I am explaining that also. Okay. Friends, this income tax department has launched a tax calculator for the taxpayers recently. And in order to assist them in choosing wisely between the old and the new personal tax regime, I have myself used this tax calculator, and this is very helpful indeed. And I have also listed the link here. I hope the site comes. My site is, this income tax site has come up. It is visible. Kindly confirm in chat. Okay. Okay. It has come now. Okay. Thanks. Friends, this is the tax calculator which the income tax department has introduced in the site incometaxindia.gov. India, incometaxindia.gov. The normal site is for filing, but this is their parity site. So here, what we can see is that you simply need to choose the assessment year and the taxpayer. That is, suppose an individual is there, then the male female option. Suppose individual, then male. Then residential status, we have to choose resident, and gross salary. Suppose in our example, I have taken the salaried person employee. Suppose we should take the example of 16, having a salary of 16 lakh. Amount deductible. This is also very educative, friends. In the calculator itself, they mentioned that what all deductions uh, uh, cannot be claimed in the new regime, apart from the Chapter 6A deductions. That is basically allowances. So this exemption with respect to travel concession 10.5 is not available. HRA 10.13A is not available. Any other allowance except 3 allowances of conveyance allowance or transport allowance or daily allowance. All other allowances under section 10.14 are not available. Similarly, 1017 allowances are not available. Then entertainment allowance and professional tax covered in section subsection clause 2 and 3 are not available. So they have educated here only that what all deductions allowances are not available. So suppose in our example, we are claiming at an 16 lakh income, the break-even point will be 4,25,000 for a salaried person. So for 4,25,000, suppose the person is claiming HRA allowance. Okay, HRA we should not claim because interest on self-occupied property we can claim. We can suppose firstly putting there 2 lakh rupees. Suppose the person is claiming 2 lakh rupees under section 24B, and apart from this HRA, okay, leave it. If the person is claiming any HRA or LTA, then that can be mentioned here. And now here also deductions allowed under both the regimes, they have educated here only that these 4 kind of deductions are available in both the regimes. That is 80CCH subsection 2 pertains to the contribution to Agniveer Corpus Fund, which is a new section, and 80CCD2 subsection 2 is respect of employer's contribution. Employer or employee, I am myself getting confused. Employer's contribution up to the extent of 10% in case of private sector and 14% in case of government employee, and 80JJAA in respect of additional employees cost and family pension deduction under section 1557 2A. So these deductions are available in both the regimes. So standard deduction need not be filled here because they are automatically being taken care of in this calculator. Deductions, exemptions other than mentioned above not eligible in the new regime. So here also they are educating us that apart from the allowances, the deductions which are available only in the old regime and not available in the new regime are the chapter 6A deductions like your 80C or the subsection 2 of 80CCD or 80CCH, or your special economic zone exemption under section 10AA, or the additional depreciation under section 32 subsection 1 2A, or some specified business activities like your income from tea business or coffee business or shipping business 32AD 33AB, those kind of specified businesses, the deduction is available. The deduction is not available in the new regime. So here suppose 2 lakhs we have already claimed, 50,000 will standard deduction. So total 2,50,000, and the deduction which needs to be claimed is 1 lakh. So 1,75,000 if we put here, sorry, 2 lakh, 4 lakh 20, 1,25,000, 75,000 only. Two lakh and 1,25,000, 3,25,000, 1,75,000 ही आएगा. So the amount of variable deduction is 2 lakh in interest on self-occupied property and 1,75,000 in chapter 6A deductions and 50,000 of standard deduction. In total, it becomes 4,25,000. So we can see that the tax liability in both the regimes becomes equal. That is 1,71,600 in both the regimes. So this is for an income level of 15 lakhs and above. The break-even point is 4,25,000 of deductions. Similarly, the deductions can be worked. The break-even point can be worked out in this calculator as well. So this is a handy thing and which should be referred. Okay. So I hope this is clear. Kindly confirm in chat. Okay. Okay. Thank you. Let me share it again. My screen is visible. My PPT is visible? Okay, thank you. So friends, this was about the income tax calculator, and the Taxman also has launched a tax calculator very handy way before than the income tax department, so that can also be used. In fact, I have worked out these deductions by using the Taxman calculator only, because this calculator has been introduced by the department just 3 or 4 days back only. Friends, apart from this, I have also written some detailed articles on this very choice of old versus new regime. And in one of the interesting article, I have discussed all the budget, personal tax related budget amendments by way of a interesting conversation of four friends. That is Dhaniram, Maniram, Buniram, and Janiram. And that published article is very well available in the Taxman website. The link is also there. And after this webinar, the presentation will be shared. So you can readily assess this article. And I have tried to cover each and everything as far as the personal tax regime, personal tax related budget amendments are concerned in a very interesting and easy to understand manner. So you can refer these articles also. Another article of which personal tax regime is more beneficial and in-depth break-even point analysis. This article I have penned down just immediately after 2 years, 2 hours after the budget. So this is also readily available. And apart from these, many other articles and the Taxman research team articles are also there in the Taxman portal. Therefore, you can readily benefit from those articles. So, friends, this was all about the choice, how to make an informed choice. And now I shall be taking up the question answers. So, one by one, let me take these questions. As per new regime, how can I claim exception on interest paid on home loan, which is self-occupied? As I have already mentioned that in the new regime, the interest paid on home loan, which is self-occupied, is not available under Section 24B. That needs to be foregone. Second is set-off is allowed on income from house property, which is let-out property. Set-out, obviously, set-out is available as far as the interest income is concerned. The net income needs to be taken care. But even after set-off, if the interest under self-occupied property is there, then then that interest deduction will not be available. However, if after set-off or you are only having the property is let out and not self-occupied, then any interest paid on home loan in respect of a let-out property is available in the new regime also. So uh, uh, that should answer your query. I hope it is clear, Mr. Yaram Chiranjeevi Reddy ji. Kindly confirm in the chat box. Okay. Is there any ceiling on the exemption of interest on let out property? There is no, as such, no ceiling, but in one particular year, a maximum loss which can be claimed in respect of house property is 2 lakh only. So obviously, indirectly, the limit is of 2 lakhs, and the rest will get carried forward in the subsequent years. I hope I am clear regarding this query. Shall I proceed further? Kindly confirm in the chat box. Okay, thank you. Now proceeding with another question. Same interest paid on housing loan is not available, then standard deduction is 50,000 or 52,000. Okay. Mr. Ganesh Shetty has asked that standard deduction is 50,000 or 52,500 under new regime for financially placed office. Friends, this is a slightly a confusing issue because I think that in the budget speech, the Honorable Finance Minister has referred that the total available deduction will now be 52,500. But the fact remains that under Section 16(2)(a), the deduction is only 50,000, not 52,500. Perhaps the reference to this benefit has been because since the basic exemption limit has increased by rupees 50,000 in the new regime, that is, and at 5%, the benefit comes out at 2,500. Therefore, the total benefit of increased slab rate as well as 50,000 has been taken into account, perhaps by the Honorable Finance Minister in the budget speech. That is why the benefit of 52,500 has been mentioned. But in my humble understanding, the standard deduction amount remains at 50,000 only and not at 52,500. Okay. Okay, provision for switching to tax regime from old to new and vice versa. Okay, I have discussed this. Mr. Devang Gajjar's question is this. Friends, I have already discussed that the new regime, with effect from financial year 23-24, the new regime will be a default regime. And if you want to opt for the new regime, then nothing needs to be done. Nothing special needs to be done at your end. However, if you want to avail the benefits of available deductions only in the old regime, and that is why you want to opt the old regime, then in case of persons having not having any business or professional income, then they simply need to select the appropriate choice of old regime in their respective ITR forms at the time of filing their ITRs, and obviously and claim the appropriate deductions. However, in case of persons having business or professional income, then they need to file a declaration form, electronic declaration form, before the due date of filing their returns under section 139(1). Currently, the prescribed form is 10IE. Hopefully, it will remain the same with from for financial year 23-24 also. However, one thing needs to be taken care here, that the person who has opted for the old regime in fact from financial year 23-24 will be given only one opportunity of switching back to the new regime during their lifetime, and after using that one opportunity, again they will not be given any opportunity. Okay, is this computation for post past also from 1st of April 23? No. Friends, in the finance bill, always the reference from 1st of April 23 or any year is with respect to the assessment year. So this is available for financial year 23-24 and assessment year 24-25. All these amendments become applicable for financial year 23-24, that is with effect from 1st of April 23 till 31st March 24, the financial year, and the assessment year 24-25. Then coming to the next question. Can you explain once again deduction of interest on home loan 24B under old and new regime, especially where the second or third out is let out? Friends, I have discussed it again, so I should not repeat the same. Having income under profit and gain, but filed ITR with new regime, should employee continue with the new and filed ITR? This is again a general question, that which regime. Our whole webinar is has been discussed on these lines only, that how to make an informed choice. Mr. T.R. Rastogi is mentioning that if in your case study for professionals claiming benefit of 44 ADA, even if the expenses are 10 lakhs, then also deemed income is 50%. Suppose the expenses are only 8 lakhs, then also can benefit of 44 ADA be claimed? Yes, my friend, the benefit of 44 ADA can be claimed for up till financial year 22-23 if the total professional receipts are 50 less than 50 lakhs, up to 50 lakhs, and with effect from financial year 23-24 onwards, the threshold limit has been increased to 75 lakh rupees. So if the professional receipts are up to 75 lakh rupees, then the benefit of presumptive taxation can be claimed even if the expenses are lesser than 50%. Okay. If in new regime my total income is 7 lakh 1,000, how much tax I need to pay? Friends, the calculator is very much there, but yes, it is true that the moment your income exceeds by 5 rupees more than the threshold rebate limit of 7 lakh in the new regime, the tax will be applicable and you will not be able to claim the rebate. That is why at from an income level of 7 lakh 5,000 to 7 lakh 29,000, the peculiar paradox is coming, that at every with every increase in per rupee increase in income, the per rupee tax liability increases more than the income. So that is the paradox is coming, and that is why we have also made a representation to the finance ministry to provide marginal relief at an income level of 7 lakhs to 7 lakh 29,000, so that this paradox can be removed. 87A rebate is available in old regime now. 87A rebate is available in old regime only up to an income level of 5 lakhs rupees and not up to the increased level of 7 lakhs. is every assessee is filing ROI in new regime from assessment year 24-25. Obviously, the threshold limit is 3 lakhs. So if the income exceeds 3 lakhs, then in order to claim the rebate, also the assessee needs to file his or her return. For assessees having business income, please explain the switching option rules. So last time I am explaining for the clear understanding of all that for assessees having business income from financial year 23-24 onwards, if the person wants to opt the new regime, then nothing needs to be done. By default, the new regime will be a default regime. However, if the person wants to opt the old regime, then in case of having business or professional income, then the person needs to file his or her electronic declaration form in the prescribed form before the due date of filing return. Currently, the prescribed form is 10IE. If the person fails to file this declaration form before the due date of filing the original return under section 139(1), then the new regime will be considered as default regime and the benefit of available deductions cannot be claimed by the assessee. Non-taxable limit in old regime is 2,50,000 or rupees 3 lakh. In old regime, it is still 2,50,000. The basic exemption limit is 2,50,000. However, the rebate limit is 5 lakh rupees. Capital gains on listed securities, whether rebate available in 87A. I have already mentioned that rebate in respect of capital gains on listed securities under section 112A are not available either under the old regime up to 5 lakh rupees or under the new regime of 7 lakh rupees under section 87A. So because this is a specially tax income tax at a special rate. Is leave encashment provision mentioned in the budget speech available in the finance bill? Friend, this 10-10 this leave encashment provision is not mentioned in the finance bill because this will be announced by way of a specific notification which is yet to come. So the limit increase in limit will be, it was there in the budget speech, but in the finance bill it is not there because this increase will be implemented by way of a notification, amendment to the existing notification in this regard. This is an interesting question. Anshuman Barua, Mr. Sir, I filed Form 10IE for opting the new regime for my business income last year. Suppose again, if I have to choose old regime this year, then again, should I file Form 10IE? I have already used Form 10IE once. How many times can I opt for it? Friend, as I have mentioned that with effect from financial year 23-24, all persons will be given an opportunity to exercise their option based on their circumstances or the available deductions afresh. So even if you have already claimed, opted for the new regime under section by claiming 10IE, but however, with effect from financial 23-24, you want to switch to the new, switch to the old regime, then you need to file 10IE with effect from financial year 23-24 if you are having business income. Since you are already filed, therefore you are already having business income, the system will accept the form. Is it mandatory to file Form 10I for salaried person also? No, it is not mandatory, my friend. It is only mandatory for persons having business or professional income. If the total income including LTCG is less than 7 lakhs, can I claim 87A rebate? No, you cannot claim. Whether employer's contribution on superannuation fund up to 1.5 lakhs is exempted under new tax regime. Employer contribution on superannuation, you are talking about 80CCD2, then it is available up to 10 lakh, 10% of the basic salary. If we claimed home loan interest under section 24 under old regime, if we switch to the new regime, can we capitalize the balance home loan now? Friend, if you have already claimed the home loan interest under section 24, then it is not possible for you to capitalize it because you have already claimed it. And the budget has specifically clarified that double deduction cannot be claimed. What is the maximum limit for claim of interest on home loan for self-occupied? It is 1,50,000 or 2 lakh. It is 2 lakh rupees. If a professional opts presumptive income under 44 ADA, the professional is still required to maintain his books of accounts. No, he is not required to maintain his books of accounts if he is opting for the 44 ADA. Therefore, in my opinion, if the professional expenses at 10 lakhs as against the gross receipt of 28 lakhs, his presumptive income shall be 18 lakh. Not, friend, kindly understand that the very rationale of introducing this 44 ADA section is of presumptive scheme is that the taxpayer is not required to maintain his books of accounts, and not the tax audit is not required if he is declaring 50% of the income. So the moment he opts for 44 ADA, irrespective of the fact that his expenses are lesser than 50% threshold, then also he will be able to claim 50% of expenses as expenses. But however, this option exercised once has to be consistently followed in subsequent 5 years. Suppose in next year his actual expenses are greater than 50% threshold, then he will not be able to switch back to the actual scenario. Then for 5 years he has to continue in this presumptive scheme. So this is a balanced scheme. So with this, in the question answer session, I have concluded. Now in the chat box also,